Good afternoon, everyone, and welcome again to another quarterly update from all of your managers inside of the TAM portfolio. My name, as always, is Aaron Ploskow. I'm the Director of Sales at AAMA. With me, I have Felipe Toews over at Toews Asset Management. I have Bob Baker with with AAMA. And then I have Kim Arthur with Main Management. So, guys, let's talk about this quarter that we just finished. I've got a lot of people talking about the double-edged sword that we're running into right now. Are we going to go down quickly on the Fed funds rate? Are we going to go down slowly? Is the Fed going to break something in here? And then, one of the things that we started commenting over here at AAMA about is the excess liquidity that's actually out there in the market right now. How is that going to get back down to normal without overly killing the market? You know what? Let's start with Felipe.
Yeah, so I think that for us, the question about how fast the Fed lowers rates is less important than if something happens in the markets that causes the Fed to change trajectory. So it's interesting. I was just at a conference out in Savannah, and it was a lot of people that had a lot of assets under management. And I will say that people on both sides of the political parties are in a mode of wanting to freak out if their candidate loses the election. So I think that there's just a feeling or a sense of dread from really the entire population about the possibility of this going the wrong way. The things that I look at in terms of the Fed funds specifically, without becoming partisan, I think that the one thing that we see out there right now that could potentially change the trajectory for the Fed is tariffs. And, if either candidate wins, if you have a divided Congress, then that prevents a lot of fiscal initiatives one way or the other. So I think that that one thing that a president can do without the legislature, which is potentially escalate tariffs around 17%, has the potential for changing the trajectory for the Fed. And I think that's the potential real game changer, because then you've got potential negative stock market repercussions and a potential that this assumption that we're all working under, that we're going to see a massive decline in the Fed funds rate over the next 24 months, could be put into jeopardy. And what's interesting is that it doesn't take action for that to happen. All it takes is the potential or the thinking that it may happen, and immediately rates could change trajectory.
Okay. Kim, how about you?
Yeah, just wanted to tag on to one thing that Phil just mentioned there on tariffs. Candidates always say a lot of things. But the good thing about this one, we have a body of work that we get to see for both candidates. And actually, even though Trump was called the tariff master, the tariff headwind, the Biden-Harris administration has had basically the same tariffs. So I'm kind of like looking at the body of work versus actions speak louder than words. So I think under either administration, I do agree that you'll probably have some sort of split Congress. So under either one, it's not going to be a major change in the tariffs from either one of them. That's just my own personal view from that standpoint. I do think that we clearly do have the 2-year, I still think, is a very good voting mechanism, big, deep, liquid market about where rates are supposed to go. And that tells you there's only 3 rate cuts in the next 12 months. 12 months, only 3 rate cuts. Fed fund futures are a very spasmodic piece there that's always trying to trade on whatever information just came through the pipeline. So that one is much more volatile, but the 2-year has a better kind of like smoother thing. So only 3 rate cuts. So that kind of tells you, we know that the economy has been much, much stronger. That's what everybody has gotten wrong. The current quarter that just ended is 3.2% GDP growth right now. So that matches the second quarter of 3%. So the economy has been resilient. Why has it been resilient? Because real wages have been positive for 17 months. 17 months. and consumers, they get a dopamine high off of spending. So that gives them a pretty good thing. The one last thing that I would throw out, it's very interesting. We're in the middle of a bull market. The first leg of those bull markets is a multiple expansion. Ditto. We had that 15 to 20 times. This one has been on earnings. Earnings have gone from the start of the year 240 forward to 270. And consumer confidence is low. Markets don't die on low consumer confidence. I know there's lots of other things that are out there. They do not die on low consumer confidence. So it's an interesting setup. The Fed's cutting rates, maybe albeit not as fast as people had wanted, and you have monetary, you have M2 growing, and you have low consumer confidence. I don't know, kind of an interesting setup.
Interesting. Bob, what about you?
Well, I would agree with Felipe, and in terms of the cycle of interest rates and the potential for the Fed, I think it's interesting that the Fed cut by 0.5 point, but the 10-year has actually gone up pretty dramatically in yield. So the longer end, or the supply and demand cycle or market for longer term interest rates, basically shrug that off. And we've seen mortgage rates come down a little bit, but nothing like what they need to have consumers really to be able to go out there and commit to buying a new house. And the fact that the Fed cut rates by 1/2 right before an election, I think now they're going to walk on pins and needles between now and the election, so they don't come across as trying to influence the potential outcome in early November. During the third quarter, we saw the S&P basically go up 6% for the quarter. But during that quarter, we had a 8.5% decline and a rebound. We also had a 4% decline, and that 4% decline advanced back in 7 days. So we've had pullbacks, but they've been very quickly reversed. And I think in terms of sectors today, every sector has basically gone from undervalued to basically substantially overvaluation, with the exception of telecom and energy. Those are in the 66th percentile ranges. And with the S&P in the 89th percentile, where it's been historically, again, we're in some pretty overvalued markets.
Perfect. Each time we've done this, you have all perfectly set me up for like another question. And, each one of you seem to grab a little bit of it. So I want to get your take on this. So, and I haven't done this before, so you may start yelling at me afterwards. You may not. Our CIO, Phil Volker, in our commentary this past just a couple days ago, put out some information about the last couple of times that the Fed has actually started to drop rates. All right. Back in 1982, the PE of the overall market was very depressed when it happened. It was at about 7.2, and the market took off. All right. Leading into, of course, what happened in 87 a couple years later, but we're not going that long a time frame in that. But relatively quickly, it took off. 2007, the same things, when the Fed started pivoting and lowering down to what we now know as, the great life at zero. The market was at a 17.75 PE. And obviously, we know what happened just after that in 2007. We had a market that basically went down, not on the Fed actually pivoting, because we all know that for the most part, the fixed income market basically stayed in line with where it was. But it was outside. So it didn't have all that much effect on the overall market. Now, we just started pivoting. We're at 25 times on the PE of the overall market. Where are we going to go at this point with this pivot? Is there a chance? Are we at the end of the upside run, which Kim kind of maybe alluded to just a little bit, because we're at 25 times earnings? How much, or 25 times the PE? How much more can we stretch this out? And Phil mentioned the fact, or sorry, Felipe mentioned the fact that, there's a lot of uncertainty in the market, and that creates a lot of drama in there. I mean, could this actually cause a pullback in the market? And then Bob was mentioning the fact that outside of energy and telecom, everything's at like their 87th percentile, if not higher, as far as where they are in their ranges. Everything is overbought on the way we look at it, a fundamental level. Where do we see things going here in the fourth quarter, leaning into the beginning of next year? I actually started hearing somebody finally start saying again that there may be a recession in 2025. Now, I think most of us here would say we've been through smaller recessions already in the past couple of years. What are your thoughts on some of these comments? Kim, let's start with you.
Sure. So I think there was a couple questions in there. I know there was a lot of data that you threw out there. So the first thing I would say is everyone loves to look back and see, well, the market historically traded at 17.5 times over the last 100 years. The economy is not the same as it was during the Depression. It was not the same as it was during the 50s. If you look at a demarcation in 1990, let's just pick that, we've become much more of a service tech company. We can all rattle off the companies that are the biggest companies right now. They have very few people that work for them. They have very high profit margins. And the key is on a profit margin. It's no different than when you buy an individual stock. If something has a 5% operating margin, you're going to pay a significantly lower valuation than if it has 25%. And the S&P, people always love to say, oh, well, look, the market bottomed at 10 times in 1982. The margins were 4.5%. In October of 2022, when the market bottomed at 15 times, the margins were 9. So significantly higher. They're 13%. Now, we can debate all day about the sustainability of that, but the market is actually pretty efficient at figuring that out. So I think there's a big difference with the economy from 1990 forward. And people will say, well, hey, if you start saying this time it's different, that's dangerous. That's 3 decades of this is different. So it's a very, very different piece there. The other thing is you need a credit crunch to blow the economy up, typically, right? Typically, the Fed, you have to look at all those cycles when they're cutting, and people love to look at the 07 cycle, and they look again at maybe at 01 or 00 there. And there was, if the economy, if corporations are bust and the consumers bust, and the banks are bust, that's a setup where things are going to be problematic. That probably doesn't exist right now. So I think you have to break these cycles out. You tell me if you can see what's the construction to have a credit crunch, because that's ultimately what causes a recession, causes a consumer to go back into the bunker. And I think, again, you need to be very astutely aware of what the profitability is and then figure out the sustainability.
Okay. All right. Bob, what about you?
Well, obviously we're at 25 times earnings right now. Let's hope we don't go to 7, because that would be a catastrophic wipeout in terms of equity prices. Could we go back to 20 or 22 and get the correction and advance from there? Sure. But also there's a lot of cash sitting out waiting to go back into equities at some point. And I'm sure there's a lot of people that wanted to get their cash in 3 months ago and didn't, because they thought the market was still too overvalued there now, and now it's even more overvalued. So at some point, If something doesn't give, I think you're going to see a lot of cash flow in, which is even going to drive prices higher. You've got the volatility of the election and the outcome of that, and the House and the Senate. And, maybe the best thing we can pray for is gridlock going forward. So we don't get one party that just goes out of sight in the wrong direction for the next 3.5, 4 years.
Okay.
I think this is a fascinating conversation. Kim, that was the first time I'd heard that stat, and I'm really happy to hear it. I recently looked at some data around the history of PEs, and we are in a new era of valuations. If you expand it out and look at the last 20-year average PE level, it's actually almost 25. So it's 24.81. Now, that's a little bit dated. That was for a book that I wrote. So that's as of the end of 2023, but whatever, right? We're 20-year period, so it's still very similar. On average, if you go way back all the way to the 1890s, you're looking at about 13.8. So not a 2x, but close to a 2x average valuations to what we've seen historically. And I would love for the reason for that to be just increased margins in the kinds of companies that we're looking at and are comprise the U.S. economy are different now. And so there's a rational, valid explanation for that. At the same time, in terms of like looking at, that the question that Kim raised about needing a credit crunch, I don't, for the last 2 years, I've given this presentation around hidden implications of global debt. And I don't think you can forget about both the sovereign, non-financial, corporate, and private debt mountain that we built. The analogy I like the best is from Interstellar, the movie, where Matt McConaughey is there with his spaceship friends on the ocean looking at a mountainscape, or what they think is a mountainscape. And then Matt McConaughey realizes, wait, that's not a mountainscape. That's a 500-foot wave that's about to crush us. And I sort of feel like, I wonder if that's not the way we're thinking about, the most explicit example is government debt, where we're at this level. We've been at 100% of GDP before in the US, but we had a hugely different demographic. Last time we had 100% debt to GDP, we grew for the next 20 years at 8% annual GDP. Like, we had lots of young people having babies, and instead of people getting old and like moving to Florida. And what's the other big example I wanted to bring up there in terms of the difference? I'll think of it. But the key is this, is like neither party right now is talking about fiscal responsibility at the government level. So you've got both parties going to jam up that. I think this is a potentially huge thing, right? So Morgan Housel in his new book talks about the fact that everyone makes these predictions and they're all based on valid economics, and then a surprise happens, right? And so it's all about contingencies and thinking about what could potentially cause a surprise. For me, you've got this trust moment where, in the formerly great, kingdom of the UK, they saw their treasuries get compressed. And what if we get to the point where all of a sudden you have problems with auctions? I know it seems like a crazy conspiratorial thing, but the reality is there's a limit to debt. And we've got this growing sovereign debt. Think about, like, we continue on a path for growing debt, and then you enter into a potential recession, which inevitably will happen, which compresses GDP, and it creates more need for fiscal stimulus. I think about all these risk factors out there, and the history clearly shows that once you go above 90% of GDP on global debt, it increases both the probability and the severity of financial crisis. So putting it all together, Aaron, I just think that the way one needs to think about this is express. I love Kim's optimism. I love the stats that he gave around. You don't bull markets don't die with a not optimistic consumer. So I think you need to invest optimistically, right? I think we should be fully invested right now. If you're on the sidelines, absolutely get out of that, but then build contingencies in, and that's why you're in TAM portfolios. Yeah.
Gotcha.
I took more than my share of real estate there, didn't I? You can skip me next time.
No, not at all. But
okay.
Again, it leads into more of a question, and it goes back to actually something that you said about tariffs. Right now, we still hear the Fed talking about wanting to get to a 2% inflation rate, to get inflation down to that. What kind of headwind are we looking for that's actually going to help that along? Because, I keep hearing, even on CNBC this morning, was it this morning? It was this morning yesterday, that, everybody's got tariffs backwards. That, if we put a tariff on China, China is not paying that tariff. We're putting a tariff on those imports. That's going to cause the company here in the US that's importing it to pay China for the actual product, and then they have to pay the tariff to bring it in. So then, in essence, they're going to raise the price on the consumer to cover what they're paying China and what they're paying the tariff. So that's almost going to be an inflationary possibility on that actual consumer because they're having to cover the tariffs as well. So if we go that direction, is that going to create the wrong kind? Is that going to create a tailwind then instead of a headwind to get us down to 2%?
Aaron, the ideal policy on tariffs, if people did this, it'd work brilliantly. You put tariffs on products that we are producing. Pretty simple, right? If we don't produce something, you don't put a tariff on it because that causes the inflation. And if you look back, like coming out of World War II, guess what we did for U.S. cars going into Europe, which was devastated, U.S. cars going into Japan that was devastated? They put massive tariffs on it, because those guys weren't producing anything. Or they were producing cars. They were about to produce cars there. So they said, great, you guys can gobble up a bunch of market share. But now the problem is politicians don't think that way. But if you sat down and thought very rationally about that, you're like, if we're making something here, put a tariff on it if you really want to put a fence there. If we don't make it, do not put a tariff on it because you gotta import the damn thing.
Gotcha. Anyone else have any kind of opinion on that?
I'm just go ahead. Sorry, go ahead.
Sure. I think part of the goal there is to have companies start producing more things in the U.S. rather than importing them from China. But that's going to take 4 or 5 years. I mean, you look at the Intel plant in Central Ohio, it's not even up and running, and that's been being worked on for 2.5 years. And now there's a question if that's really going to come to fruition. So, that onshoring, some of it takes place immediately, but most of that's going to take place over, 4 to 8 years at a minimum.
Aaron, at a risk of talking too much again, that really actually brings it back to the reason I brought up tariffs in the first place, because I think that, I similarly think that, will that really happen? Because the size of the tariffs being proposed are massively bigger than the 2016. So that was a 2% total on average tariff structure for imports. This is 17%, and it's focused what's being discussed here is that. Right, it's focused on China, and we can't necessarily make all those things. But what it reveals is a need to build in contingencies, because if you do, as you're suggesting, potentially change the trajectory of inflation, and then that changes where we're going with rates, you need to be in different parts of the fixed income market. Of course, our role in the TAM portfolios is the fixed income piece, or at least a significant portion of that. And so right now you want to be in high yield, because you've got a 3% yield advantage and the potential for appreciation if the economy and stocks do well. If you have a situation where you've got, for whatever reason, go into something like it looks like a hard landing and the Fed's lowering rates, you really want to be in 5 to 7 year treasuries where you can get a little bit of appreciation as the Fed brings in rates. And if you get emergent inflation, where all of a sudden the Fed changes trajectory and maybe the economy doesn't do that well, now you want to be in T-bills. So really thinking about fixed income and the ability to be adaptive is crucial when you consider contingencies and scenario analysis around what's going to play out over the next 12, 24 months.
And I think that confirms the fact you want to be diversified That's what the TAM portfolios offer to advisors and their clients, and you get basically three moving pieces that are going to work together and diversify portfolios.
You guys are all working off of each other yet again and leading me into our last question, which is for your piece in the TAM portfolio, where do you stand and how do you see it adding I guess the word alpha to the actual overall mix? Philippe, you said
Yes.
that you're basically fully invested in high yields right now. How do
Right.
you see that going?
So if you look about 13 months ago, when everyone thought that T-bills were the best thing ever, we were actively saying that T-bills is a losing trade moving forward. And so we've largely, although there are times when we've been out briefly over the last 13 months or so, out of high yield, we've been in high yield bonds, and that has been a good trade because it's outperformed aggregate bonds, it's outperformed T-bills, and it still continues to be the place to be. And we will continue to stay there unless something changes. And we have the option of being in 5 to 7 year investment grade or T-bills. We're fully in high yield right now.
Okay, perfect. Kim, how about you? How are your?
Yeah, and the sector rotation, again, we think that these rates are going to be a little stickier coming down because the economy is better. Okay, because the economy is better. That's a high quality situation, we think. So as a result, I want to own growth at a reasonable price. So we've got a lot of growth at a reasonable price that's positioned. So think of, you've got certain subsectors of technology, you've got certain pieces in the healthcare spectrum, you've got mid-cap growth. We think all of those look like they're very attractively valued. And then in the income piece there that is kind of complementary to what Phil's doing there, we're still finding the volatility index is high enough here that you can still get mid to high single digit type of in the money call writing that is happening. And like Phil said too, the high yield market is telling you that the economy is doing just fine. Spreads are pretty narrow. And that's an interesting setup when you have that with the VIX at an elevated period here, because people are scared to death, like Phil said, about the election. That probably means there'll be a relief valve going up. And everybody that we've all been talking to, they're like, oh, wait till after the election, then I'm going to allocate money. Mr. Market loves to inflict the most amount of pain to the highest number of participants. And that's why the market's marching up in front of that event.
Perfect. Bob, how about you?
Well, in our equity piece, we've been focusing on high quality balance sheets and quality companies. We've had exposures to the industrials, telecom, utilities. Our tech weighting is a little bit less than the index, but I think we've focused on quality balance sheets, a little bit more of a defensive equity position. And once we get confirmation that some of these answers or questions are answered, then it potentially would be a time to turn back up the risk in the equity piece. But we're being very conservative right now until we get some of these things digested.
Perfect. That's great, which is why we have three different managers with three different mindsets. Last words from all of you. Kim?
I think, again, we've got a great structure, as you've just heard from three different managers, and it's blended together to help kind of keep you and your clients in the market and not get knocked out. We're doing the active allocation and the active fine tuning inside of it. So I think stay the course.
Perfect. Felipe?
Staying in our lane here, despite expressing certain elements of skepticism around everything, I would like to convey optimism around the fixed income space. The study that I did looked at how bonds perform during a falling rate environment. It's quite good on average. The other thing you look at is if you look at the starting yield at the time you invest in bonds, that tends to be predictive about yields ahead. So regardless of what we see playing out in the economy or even inflation trajectory, I think that you can be more optimistic about the bond piece than let's say 2 years ago.
Perfect. Finally, Bob?
I would concur with both Felipe and Kim. Stay the course. I think it's a great opportunity. You get three great advisory firms working for you, and three potentially very different, diversified and differing investment alternatives between us.
Great. I enjoy doing this every quarter. This is great. I love talking with the three of you. I love the fact that I've got three CEOs here who are able to carve out some time to do this for their clients, which just attests to the way all of us do business and how we do it together. Again, I thank you so much. I thank everybody for listening in on this. If you have any questions at all, you can go directly to www.tamportfolios.com, which will have links to all three managers directly, so you can look at all of their commentary and information, or you can reach out to either one of the three main wholesalers, meaning top wholesalers for this, not just main wholesalers. We've got Wayne Seaman at wseaman@mainmanagement.com. We have Eben Burr at eben.tayscorp.com. And then we have myself at aplaskow@aamamail.com. And any one of the three of us can answer questions that any of you may have on any of our great CEOs that we have here. Again, thank everybody for joining us, and we look forward to talking to you again next quarter. Thank you.
Thanks, everyone.
Thanks. Take care.